Limited companies. Let's talk about limited companies and property developers. Now, what I do need to say is we're talking about now the 18-19 tax rates here. So you do get £11,850 personal allowance before you pay any tax. You pay 20% basic rate tax band once you earn over that, and up to 46,350 combined. And then over that, you pay 40% and then 45%, as the slide shows here. Now, if you buy any property to flip in your own name, you will be paying income tax. Okay, so let me be clear about this. If you buy and then sell a property without renting it out first, you will be subject to income tax immediately. So please bear that in mind when you're doing some tax planning. You are not going to be in a position of capital gains tax if you are simply buying to sell immediately. That will be seen as a trade, and as a result of that, you'll be having to pay this amount of tax. And one of my avid webinar attendees, who's a client of mine, a great guy, we've had conversations about this time and time again about the difference between buying properties, sell them in your own name, versus if you use a limited company. The other side to this is national insurance as well. So as a self-employed person, trade, because you're trading properties, you also have this stealth national insurance tax as well. So you can start to see that you'll pay 9% national insurance on any profits between those two numbers, and then 2% beyond. Now, obviously, your year end is the 5th of April, so tax would always be payable the following 31st of January. Why am I showing you this? Well, I want to show you something here whereby if you buy properties and then rent them out for a period of time, please don't jump on here with your keyboard questions saying, well, how long does it take before I can buy a property and then set it out to be classified as CGT? That's not a question I'm going to field right now, because HMRC aren't bothered about timeframes. They're bothered about qualitative information, not quantitative. So please don't ask me about that because I can't go into too much detail about this on this webinar. But what I do want to emphasize is that if you buy a property, you've rented it out, and now it's Section 24 is coming into play, you think, well, maybe that property isn't right for me, maybe I need to do something with it, then you can sell that property and you will have your first 11,700 would be CGT free, because that's your annual allowance. And if you're a couple, by the way, you would have that twice over. And then you'll have 18% tax as well for any earnings below 46,350. And then anything over that, 46,350 profit, you will have a tax bill of 28%. So you do need to think about the kind of taxes that you could have. Now, this is not really a property developer. This is more of a property investor, because they have bought the property to rent out first. That's the distinction. If you buy and to hold an investment, that's what it is. It's an investment to rent out business. If you buy properties to sell, that's a trade, and therefore CGT will not be allowed for you. And this is whereby we say capital gains tax. Now, capital gains tax is chargeable still in limited companies, just differential in terms of names. The capital gains tax in a company is only 19%. So, and that's going to come down. So we talked about the fact that you've got potentially a 40% tax bill with 2% national insurance, which is 42% at least as higher rate taxpayers on property trade, compared to 19% in a company. And one thing we also need to emphasize is that you do get £2,000 allowance of extracting that money for each shareholder from the company, irrespective of how much you earn. So if you're happy to kind of drip feed money into your coffers, then ultimately you could just have your property development company pay 19% tax, not the 42% as we've alluded to earlier. And I wanted to just, again, bring to light here in terms of the numbers. And what we've tried to do here is show you different levels, because I know you guys, there's different levels of investments that people are making. And there may be somewhere even more than this, of a million plus, but I've just tried to give you some baseline numbers to work with. So this is an example where a property developer has sold a property and made £100,000 profit, £250,000 profit, and £500,000 profit. And what you'll notice here is the level of tax that will be paid income tax wise on 100,000 is 32%, nearly 33% there. And when you get to £500,000 profit as an individual, you are paying quite a substantial amount of money, actually 40% tax on that sizable profit. And the reason for that, by the way, is because once you go over 150,000, you pay 45% income tax plus 2% on the national insurance. So it's a substantial amount of money you have tax. CGT, again, if you're buying to hold for a period of time, then selling that property, you can see the CGT levels are lower, but the biggest saving is clearly money in a company that is then selling those properties, and it's only paying 19% corporation tax, which again, please bear in mind that limited company rates, corporation tax rates will be decreasing. It's likely that limited company rates will be falling to 17%, and who knows, it could go to 15%, it could get to 14% or below, because of the way that this country now needs investment coming into this country, with the issues of America trying to reduce their tax rates. And you've also got Brexit, whereby we will need to start attracting investment into this country. And therefore, tax cuts for corporate companies would be most welcome. So I would expect that corporate tax rates will be lower, and therefore we should start to see a reduction of tax in these examples as well as we go forward. Now, I wanted to bring into your mind's eye about TAAR. TAAR is a new targeted anti-avoidance rule, which is not GAR, which is the general anti-avoidance rule. This is TAAR. So TAAR is not well, let's just focus on what TAAR really is. So TAAR was introduced in the Finance Bill 2016. And basically what it's trying to do, I'll let you read the narratives yourself. I'm not going to kind of reread it out. But what it's trying to do is stop people, property developers, setting up a SPV. An SPV is a limited company, which stands for Special Purpose Vehicle. And what was happening is that you would have an individual that would be doing property developments and then closing that company down and then taking the money out of that company. So in the example of £100,000 worth of profit, the company would be taxed at 19%, so 19,000. They would have £81,000, and they would have an entrepreneur's tax of 10%. So what HMRC are trying to do here is say, well, we don't want those serial investors repeating the process of opening limited companies and then closing them down again. And if we find people doing it, what we will do instead is charge them an income tax. So this is now the 40%, 45% tax plus the 9% or 2% national insurance charge. So they could retrospectively go for you if they find you being a serial entrepreneur using limited companies, which is a detriment to them in terms of collecting tax. So you do need to be careful. You do need to take advice before you get into this place. Now, what I would always say about this ruling is that if you are a property developer, like the big developers you see up and down the country, whereby you are buying properties and you've got a longevity plan of 5-10 years to constantly buy and develop and sell properties, and then eventually close it down, then, well, that will be okay, because it's not within the 2-year period as it states there. So as long as you're not doing this on a regular serial basis and you've got longevity in your strategic thinking, then TAAR will not affect you. But if you are thinking about setting up all these limited companies and closing them down one by one, year after year, then expect a call from HMRC, because they want more tax from you, and that's one of the things that they've tried to avoid.